Now we've come to a troubled weekend. The end of a troubled week is here for the financial market space. Thankfully, that ends today as we head into this Saturday. The sell-off in advanced markets also hit frontier African bourses, including Nigeria, just as the specter of inflation and a return to interest rate hikes stares central banks in the face. Let's unpack the unnerving week now as we bring on Chukwu, a market professional, a licensed dealer, and CEO at Carry Asset Management. Good evening and welcome to the show. Good evening. Thank you very much for coming through. Okay, Chukwu speaking to me. Well, of course, we're going to start from Nigeria because there's a charity begins at home. So we're going to start to chart to the Nigeria's market week, where the market here in Nigeria was brought down very sharply this week by MTN shares, which was down roughly 4%. We saw a sell-off also in the shares of other big names on the exchange. Chukwu shares were down 7.17 this week, and Zenith Bank lost 4.65%. As we speak this Friday evening, the Nigerian market was bruised by 1.58% since Monday started. If you take that on a month-on-month basis, we're now roughly 2% negative. Since 2023 started, the market is now printing just a positive 7.15%. So let's connect into Chukwu's online now. Johnson, thank you so much, sir, for coming through. We appreciate that. I was saying just before you came on that charity, they say, begins at home. So let's start on our market street. How bad was the sell-off on the equity side this week?
Well, it was quite strong, given the fact that previous weeks we've not had this level of market decline. In terms of market capitalization, in terms of market index in the past couple of weeks. So what we'll say is that, of course, we are going through an uncharted political environment. This is just the week preceding the governorship election. The presidential election is still disputed, and there are concerns by market investors on the economic and political trajectory of the country. So I could attribute the market sell-off we witnessed in the past 1 week to those concerns. What I would say, it's, of course, market goes up and down. The election comes up tomorrow, and hopefully, if the election is successful and the outcome is acceptable to Nigerians, market will begin to stabilize.
Well, who are the net sellers this week? We're looking at foreign investors, local investors, institutional investors, or retail investors. Who really is moving the big numbers when you look at MTN down roughly 5% in the week, Zenith Bank about a 5%, Chukwu down very sharply 7.17%, to the Access Bank lost about 2.3%. That's quite heavy.
Yeah, if you look at the market activities in Nigeria today, is largely dominated by institutional investors. Foreign portfolio investors are quite weak in the market. So you see a market that is largely dominated by local institutional investors. So when you see a sell-off of this size and volume, it clearly can only be attributed to institutional and local investors. In terms of retail investors' impact in the market is quite weak because of their capacity to trade large volumes is also constrained because, of course, we know we don't have credit going into the private sector retail investors in the equities market. So what we witnessed last week was largely as a result of activities of institutional investors.
Well, so here we are with a very troubled week for global markets. Finally, thank God, it's a Friday. So, but again, from Silicon Valley Bank, a trigger in the US just last week, sometime late last week, and we all thought it's just going to be an isolated case. Then again, the whole nervousness and volatility begin to creep in, and a few other banks begin to get knocked on. So give me your take on this global banking shake-up of the week.
Yeah, Boston, the global banking shakeup is actually of concern to me. If you consider the fact that Silicon Valley Bank collapsed within a period of 48 hours as a result of run on that bank. Of course, there are other underlying weaknesses in the bank as a result of the structure of their portfolio, their asset investment, the fact that they invested hugely in federal government U.S. government bond instrument at periods when yield was close to zero, and we've seen multiple increases in rates, which made their bond portfolio to become negative in terms of yield. And they sold down part of those bonds and realized losses, and they wanted to go to the market to borrow, and the market reacted negatively. So, but the speed at which Silicon Valley Bank collapsed should be of concern to anybody. Added to that, we're now dealing with the issue of Credit Suisse, a bank that has been in existence for the past 167 years. It's actually facing a major bailout by the Swiss Central Bank. The Swiss Central Bank is offering to put about $54 billion into that bank, and there are concerns that that will not be enough to plug the hole already in the bank. And we also seen other banks, other regional banks, teetering on the edge of failure. So for market operators, for the financial system, it could actually have a contagious effect. Of course, because Nigerian banks are not as exposed to foreign international financial markets because of the fact that our currency is not convertible. So we may not have the contagious effect on the local banks, but we are going to have the impact of a failure should the Credit Suisse fail on Nigerian HNIs, because a lot of Nigerian HNIs, that's high net worth individuals, institutional investors, keep their monies in Credit Suisse and other Swiss banks.
Interesting point you're just touching on. Again, if you look at what Moody's just said about the level of resilience, if you ask me, on African banks that are not likely to be impacted by the Silicon Valley fiasco. Let's dig deeper into that. Again, when you look at the fact that Moody says we've got very strong deposit here in Sub-Saharan Africa as far as our banks are concerned in terms of capital adequacy and liquidity. Talk to me about along these three major pillars when you look at the parameters that you use to gauge the level of how solid banks are as far as Africa is concerned, even though our currencies in the main, with the exception of perhaps South Africa and Egypt, and the CFA not convertible as it were, globally speaking.
Yes, like you rightly said, most African currencies are not convertible. But beyond the issue of convertibility, African banks will largely be impacted by endogenous factors. Those are factors within the African economic environment. Because, like I said, the level of linkage between African banks and foreign banks are not as strong because African banks hardly invest in foreign financial instruments. But coming to in terms of the stability and the liquidity of African banks, the Moody's report said that on average, the banks that they rated have average liquidity about 43% in Africa among the banks they rated. And if you further decompose that to the major economies in Africa, you realize that the Nigerian banking system, the rated institutions, those Nigerian banks rated by Moody, had an average liquidity ratio of 46.8%. Well as a country like Egypt, the Egyptian banks have the highest liquidity rate of about 63.8%. What this means that the total liquid assets to total assets of these banks, it's in the region of 43%. It then means that at any point in time, they need to have a run above 43% before they need to go to the central bank for support. And if you even look at the structure of those liquid assets, most of them are cash and near cash items, investment in treasury bills, balances with the central bank, as well as interbank placements. These are liquid assets that can be called back at short notice. So even if you have a run that we don't expect to happen in any African bank, the African banking system have the liquidity to meet up such run up to 40% of their total deposits. And before you have a run of 40% of the total deposit, then we are dealing with a systemic problem. So I agree with Moody's that African banks may not suffer the level of losses that foreign banks like SVP, that's Silicon Valley Bank, or even Credit Suisse is going through. And that factor going for them is that African banks do not have so much of their assets in bonds that they bought at very low rates. Their total bond to total assets is just about 110%. And that means that, and these bonds are not, even if they have all their life losses, all their life losses cannot be as huge as the type you have in a bank like SVP.
So broadly speaking, someone was on Twitter this morning, was asking me if we should do a stress test on our banks, as it were, based on what Moody has just said and what you've just explained as well. Do you think we need to do a stress test in any way, or should we just test whether everyone is okay, or we should just move on and believe that we're just going to be fine and that we are fine?
No, what I think the central bank needs to do is continue to monitor the liquidity of the banks. One must continue to monitor the capital adequacy ratio. If you monitor and then ensure that banks manage effectively their loan portfolio, because factor that could lead to a bank failure is issue of investment, the category of investment. Like we're talking about SVP, where a huge part of their investment was made in bonds whose values have declined, and by the time they sold about 2.2 billion of those bonds, and they realized a loss of about 2.2 billion from the sale of those bonds, and they wanted to go to the market to raise fresh equity. The market reacted negatively, and investors began to take their deposits away. So for Nigerian banks or African banks, the central banks need to keep a tap on their liquidity. We talked about liquidity now. We said their liquidity position is comfortable. We need to continue to keep a tap on their capital adequacy ratio and ensure that their risk appetite is not voraciously high, so that they don't begin to create risk assets that will weaken their solvency ratio, weaken their liquidity ratio, and could put them in jeopardy.
We're yet to get earnings for full year 2022 from some of the big banks in Nigeria. What's your outlook on those numbers? We're now effectively in the middle of March. First quarter is just about 2 weeks away for the end of the quarter.
You know, it was interesting. The banks are actually enjoying some level of tailwind effect despite the difficulties in the economy. In the first place, if you look at the interest rate environment, you see the banks actually increase their lending rates in the past couple of months, while they've not been able to increase their deposit rates. So the banks are enjoying an increase in net interest margin, and we should expect that to reflect in their profitability. We also seen a lot of pivoting away from brick and mortar over-the-counter transactions to electronic payment system, which gives the banks larger or higher level of revenue in terms of commission, because if the banks do not have to deploy the same level of human resources that they need to do if they have to service the customers through the brick and mortar channels. So the banks are enjoying increase in non-interest income in terms of commissions and fees, and they also enjoying higher interest margins because the lending rates have gone up without increase in liquidity ratio, in deposit ratio. So I should expect that the banks will come out with some level of improvement in their earnings, and most importantly, improvement in their bottom line, the profit level.
Okay, so let's throw some macros into this conversation. Nigeria's inflation for the month of February came in just slightly higher at about 21.91%, and this whole global nervousness over where interest rate will go. Some folks, are you worried right now about the rising level of inflation, not just in Nigeria, even though we're seeing inflation somewhat tepid, a bit lower in Ghana, for example, about 52.8%. But again, do you think the fear of inflation or high inflation is away and we can just say, well, it is time for us to sit back and see how things go?
You know, interestingly, the central bank had deployed almost all the tools at its disposal to fight inflation. The inflation we're facing today is structural in nature. It's largely driven by food inflation. Apart from the food inflation, we have seen higher increases in fuel and other energy inputs. And these are factors that are coming from the fact that we don't have enough foreign exchange, and then we are seeing the depreciation of the local currency. The pass-through effect of the depreciation of the local currency is also reflected on the inflation level. So the inflation pressure we're facing today are beyond what we can ordinarily fight with the conventional monetary policy tools. So we're going to live with it for some time. I was actually thinking that we should see some moderation because of the impact of the cashless policy of the central bank on prices. But maybe we witnessing a lag effect. Probably we see that slowdown in inflation in the month of March when the March inflation is published. But the basic thing is that I do not expect the global central banks continue to increase interest rates. I think the Federal Reserve Bank must accept some blame for the failure of SVP because of the rate at which it increased interest rates, and which led to major depositors with Silicon Valley Bank withdrawing, not able to access money from the private equity market, and they had to take back their deposits. And then the fact that those increases in interest rates also led to decline in the value of bonds, or loss in the value of bonds. So with that at the back of the central bank governors, I do not imagine that they will continue in the trajectory. And some of the pressures that we've seen in inflation were not addressed, could not have been addressed by monetary policy, because they were caused by structural problems.
Justin, again, but here we are tonight. What the U.S. Fed wanted to start doing, what everyone was thinking was going to have quantitative tapering, at least taking back some of all those multi-billion dollars. I'm sure you know that COVID-19 2020-21, roughly more than $2 trillion plus went globally into the market from central banks around the world. Everybody was printing money fast and furious on both sides of the Atlantic, wherever you are. So we're all printing money. So we talked about it. Then you have quantitative easing that we want to say, fine, can we begin to slow down, including the European Central Bank? But here we are with the ECB raising rates this week. So do you think there's any room for Jerome Powell on Tuesday, Wednesday next week not to raise rates by whatever margin, 25, 50, whatever?
Yes, I think Jerome Powell actually has a job well cut out for him, because, like I said, the U.S. financial system is going through a major challenge, and the impact of that could be contagious across the U.S. financial system. So with what has happened to SVP, the fact that although Credit Suisse is a European bank, of course, we know Credit Suisse has branches and offices in the U.S. and several other countries. So, and even the president of the U.S. has weighed in on this issue and said, look, they are going to guarantee loans, deposits, but they will not guarantee equity investors and bondholders. So what that means is that it has gotten to the highest level of decision call for the U.S. government. And I think they need to balance the need to continue to fight inflation by increasing interest rates, and the need to preserve the financial system, not just the U.S. financial system, the global financial system. And I want to believe that they're going to weigh in on the side of preserving the financial system than fighting inflation in the immediate.
Okay, so how do you think the Nigerian Central Bank will decide on Tuesday? It's going to be very heavy next week, I'm sure. Monday, Tuesday, Wednesday. So, briefly.
Well, I think the central bank governor would by now have accepted the fact that the approach to fighting inflation through consistent increase in monetary policy rate that was done in the past, the last sitting of the Monetary Policy Committee, it's not working. We've just seen an increase of 90 basis points. 9 basis points in inflation from 21.82% to 21.91%. And that is irrespective of the fact that the MPC increased rates at the last sitting. So if you continue to drive that, you also have to be conscious of the fact that, look, the economy will take a bashing from that. And I've always said that managing the economy is a delicate balancing act. You have to weigh the options of just increased rates at the detriment of economic growth, as well as the need to have some level of stability in the macroeconomic environment. And today, there are too many variables that are in the air. You are dealing with political uncertainty, you are dealing with high inflation rates, you are dealing with pressures on the exchange rate, then you're also dealing with high unemployment rates, that you're dealing with slowdown in economic growth. So I think if I am to make that call, I will expect the Monetary Policy Committee to allow rates to remain where they are at their next meeting.
Oh, okay. Do have a wonderful weekend, sir. Johnson Chukwu, Group CEO at Carry Asset Management. Thank you so much. Let's get together sometime next week to follow up on some of these big market headlines. We appreciate it.